Hi, I'm Gio.
And I'm Oscar.
This is the Come Up.
Today, we're going to talk to you about one of the most popular ways of investing to become wealthy: index funds. Index funds are a way of diversifying your investment. If you don't know what that means, we'll explain it.
And stick around till the end because our bonus today is we're going to talk about other forms of diversification.
Quick disclaimer, we're not financial advisors. So what we talk about today is for informational and entertainment purposes. To give you a general feel of what we're going to talk about, we're going to address how when you invest in an individual stock, what are some of the issues and worries that you might have, as opposed to when you invest in an index fund, how that helps minimize some of that risk. So let's get into it.
So some of you may have heard the expression, don't put all your eggs in one basket. In this analogy, if you were to spread your eggs to other baskets, in this analogy, you could decrease your risk by spreading your eggs through multiple baskets. Well, when investing in stocks, it works the same way, where if you spread your money across multiple stocks, you would decrease your risk.
So what problems can arise when you invest in a single stock? Well, you are exposed to any drastic changes that might occur with that company, or something drastic happens in the industry. Or, for example, we talked about Chipotle a lot in the past. They had the E. coli outbreak, and yes, they've recovered since then, but they took a big dip right after that happened, and it can be scary. People don't want to see their investment take a huge dip like that. And so one way to help minimize that risk is by investing in an index fund. And you're spreading your investment into many companies so that if one takes a dip, there'll be others that do really well. And if you look at the 5 or 10-year average returns of an index fund like the S&P 500, it's about 8%. That's because companies overall combined tend to do better than...
They balance each other out.
Yeah, exactly. So, and not all stocks are created equal. So you have to take into consideration a lot of factors about the leadership of the company, the fundamentals of the company, their strategy of where they're going, their competition. There's just so many factors that you have to research. And if you invest in an index fund, then you really can just set it and forget it. You could just contribute that money on a recurring basis, and you don't have to worry about spending hours or days of doing research, and losing sleep over it.
So the idea that Oscar has talked about, where instead of investing in one stock, you can spread your investment throughout multiple stocks, or what are called asset types, that is called diversification. So we've talked about index funds as a general concept. But to put it into practice, what you want to look for in your investing platform is something called the ETF. ETF stands for an exchange traded fund, which means it's basically an index fund that you can buy with either Robinhood or any other platform. You can buy it the same way that you would buy a stock. There are two ETFs that track the S&P 500, which are SPY and VOO. Those are very good, safe places to start. There's also a third one called VTI. This one tracks the entire stock market. And when you invest into those ETFs, you will be diversified across hundreds of stocks.
There are many firms that offer ETFs. One of my favorites is Vanguard. The reason being that they have some of the best, lowest costs for ETFs. And without getting into the technical details, the key to look for is the expense ratio. Most Vanguard funds have a very low expense ratio. Generally, for myself, I prefer ETFs that have an expense ratio under 0.05%.
If you've liked the content here, please like and subscribe because it helps the YouTube algorithm. And don't forget to leave us a comment.
Okay, you've made it this far, so you get some bonus content. So there are ETFs that can help you diversify your funds in other ways. For example, there are green energy ETFs. There are ETFs that help you diversify in certain geographies around the world. So if you want to invest in Asia or emerging markets. So what you can do is you can actually just search on Google Vanguard ETFs. And it doesn't have to be a Vanguard, but I like to look at their ETFs. And the first or the second result will take you to their page that'll show you a list of their ETFs. And then you can click into the ones that you're interested in and read about their purpose and their top holdings in terms of the companies that they're mostly invested in. And you can see their performance as well, their track record for the last 1, 3, 5, 10 years. And that is another way to diversify your funds. Then you just go back to the platform of your choice where you buy your stocks, and you can search for the name of the ETF and you can buy it there.
So hopefully by now you can see the value of diversification. Thank you for watching, and special thanks to everybody that has been watching and supporting this channel and commenting up until now.
See you next week.
See you next week.